This episode is brought to you by Valora. Valora is a self-custody, mobile-first wallet and the easiest way to send, swap, collect, and purchase digital goods on the Celo blockchain. Download the app and start exploring today at valoraapp.com/empire. All right, everyone. Welcome back to another episode of Empire. We've got the roundup this week, but we have a special guest, which is who's Ben Forman. Ben, longtime friend of Blockworks. Also, are we calling you Santiago's ex-boss or colleague? Santi, can we use the word boss here?
No, like no. I used to work for Santiago back in the day. No, we are former teammates.
Former teammates, still friends. Ben is a repeat guest. Probably, we've had a few people come on the pod, but Ben, this is your third time now on the pod.
I think so. I think I was on Valora once, and then on Empire once. Yeah. So this is my third time.
Yeah. So great to have you on again, Ben. You have unique perspective in everything that's going on in crypto. And so anyways, should be a great episode.
Ben and Santi, I have a kickoff question for both of you all. So just for listeners, we're going to start off with we usually do the roundup on Friday. So we're going to talk about a couple of the big news stories of the week, specifically Binance and Maker moving kind of towards the end game. And then we'll do a much deeper dive with Ben into like state of DeFi, state of venture that I think will be really interesting. But Ben and Santi, question for both of you all to kick this off. Basically, we saw Binance, who has like, depending on what metrics you look at, somewhere between 70 to 90% market share of all trading volume in crypto. Their founder, CZ, was charged with evasion of federal law, operating an illegal crypto derivatives exchange by the CFTC. It also just came out like a day or two later that Binance was kind of hiding these substantial links to China for the last several years. Would be curious to get your take on just like, there's I think Adam Cochran take, which is that this is CFTC going for the jugular and that like this is the dagger that brings down Binance. And there's other takes being like, this is just FUD, this is way overblown. So what is your take on like signal to noise of this Binance lawsuit?
Santiago, why don't you go first?
This is where the former boss kicks in. Yes, sir. Well, I think it's too early to tell. And I don't mean that as a cop-out answer. It does feel, I think the CFTC, historically, their win rate has been higher. It's like a 47-page doc, well-documented. Amongst the more interesting things are, how did they get access to his phone records or Signal? And so I think it's a fairly meaty case. I think the precedent here is also BitMEX. They were charged with, I think, not having proper KYC, anti-money laundering policies in place that allowed for fraudulent activity to take place. There's some records here as well in terms of, some chats there with like there's some links to, bad actors, I guess. So I don't know what the outcome of this will be. I'm not sure it's like a fatal blow. I think Binance continues to operate in some capacity. Maybe Binance US has to shut down. Probably a huge fine. As far as how Adam's point was, it's going to be such a big fine that, basically CZ goes, bankrupt and Binance as well. I'm not sure that's all correct. But it's too early to tell. I'm not an expert into how these cases get settled. And like I guess the last point I'll make is in the BitMEX case, initially it felt like this is a huge blow. BitMEX is going to go out of business. BitMEX certainly had a reputational hit. I guess the more important question is, if you're a fund, if you're an institutional player in crypto, are you going to be able to operate with Binance and transact with them? I would argue a lot of more established funds weren't even interacting with Binance in the first place. And so the question then becomes, from a retail perspective, does that actually hinder their business going forward, where the power and influence that Binance has, the dominance that it has, just goes down? And candidly, maybe that's a good thing.
Right. I think that's the main point, Santi. There was this the Wintermute founder, I'm blanking on his Yevgeny, tweeted out, he said, what I genuinely didn't know in this whole Binance thing was that it's not just retail that's not allowed to trade derivatives on Binance, but any US-based entity, however sophisticated they may be. And then he kind of subtweeted it and said, all the largest US algo trading firms have stopped trading derivatives on not just Binance, but all exchanges. that's a fairly big development for the whole ecosystem, not just for Binance. So Ben, I'm curious to get how do you contextualize something like this?
Yeah, I think that there are a few like kind of second derivative spillover effects of something like this. Like one is I just think it pulls even more activity on chain. Following FTX, like liquidity was kind of deleted. A big chunk of liquidity was deleted out of spot markets. Market makers pulled off many centralized exchanges. And so if to the extent Binance has to kind of curtail its trading activities, that's a further blow. But you've seen recently kind of MetaMask users like really pick up the past few months. I think they had like the single largest day of swap volume. Gnosis safe deposits have picked up a lot. Uniswap had one of its highest months of volume on record. So I think this kind of pulls more volume and activity back on chain, or could. But look, I think for a while, we're not going to really know the outcome of this. This is probably going to be a multi-year lawsuit. And I think for the time being, it's a bit more noise than signal until we really understand more of the facts.
I'll go back to just emphasizing one point here, because I have been getting pinged more and more so by traditional players and be like, it's hard to be, to your question on signal and noise, there's a lot of noise on this. I think a lot of people, their interpretation of these lawsuits and enforcement actions is very kind of knee-jerk. I think you always need to peel it back and say, you have to wait until this goes to court. A lot of times it just gets settled, like Kraken settled, but like Coinbase will go to court. And I think that's a more interesting thing that we should be paying attention to. Like, you need to believe that the US has a very good judicial system that will interpret this. And by the way, that's the interpretation that we need, because we need policy, and that's probably going to come in 2024. And so in many ways, I think this is very net positive for the space. I mean, Ben, you and I used to talk about this. So many people just say, I love crypto. I believe in it. In spite of FTX, in spite of Terra, we go back to the episode of Morgan Stanley. Those guys are still going to continue to cover this space. It's just like this lingering like regulation and lack of clarity that is really the most hurtful thing to the space. And so all of these cases, I think, are going to push us closer to the direction of we're going to finally, I think, get some greater clarity, Binance included. Yeah,
that's a good point, Santu. I mean, Ben, what's your overall framework for this? Like, I think at this point, it feels pretty clear. I don't know what we want to call it, Operation Choke Point 2.0 or crackdown on crypto, kind of cutting off the onboarding exchanges and folks, venues and things like that. Like, what is your framework for how you're viewing just like this big regulatory crackdown in the States right now?
Yeah, look, I think it's a short and medium term headwind in the US. I think Gensler's term officially ends in April 2026. It's a 5-year term. So we're kind of 2 years in, 3 years to go, and maybe it ends earlier. But I think this has a shelf life because whoever replaced him I think odds are they'll be more constructive and friendly towards crypto. But look, like the way I kind of look at this is crypto is a global asset class. I think that's sometimes lost. The US has 4% of the global population. 10% of crypto users are in the US. 10% of crypto trading volume, by our estimate, is in the US. So 90% is kind of overseas. I think only 30% of crypto developers are in the US. So I think you can underwrite a thesis around crypto, ex-US, and still believe in just a massive TAM. But I mean, look, it's been a very uncertain regulatory environment. It's very difficult to convince someone to build in crypto in the US without that regulatory certainty. And so, look, like long term, my general view is, good technology wins. Period. It's kind of like holding a balloon underwater. It eventually comes to the surface. That's the kind of natural gravity of things. And I don't think we're going to have perfect regulatory clarity for a while. But I've always viewed kind of regulation as more of an opportunity than a risk. And there's a question of like, what's the market pricing in right now? And I'm not sure it can get, materially, I'm not sure how much worse it can get unless we go back to 1933 and there's executive order
Yeah, I was gonna say don't say those things, Ben. I feel like anytime that Santi and I say it can't get worse, it usually gets worse. But
yeah, maybe. I mean, look, like I also, I was at TPG in 2011, 2012, and we were looking at the Uber Series B round. And at the time, literally everyone said, hey, this business model ride sharing will never work. The taxi union will never allow it to happen. I think like in Paris, like the taxi unions were blocking the major highway and they shut it down in Austin. And then like people just realized like it is a 10x 100 improvement to use Uber over taxis. And it won. And it was like jurisdiction by jurisdiction, and it took time, and there wasn't clarity, but it ended up proliferating. And same with Airbnb and, the hotel union. So crypto is no different. It's going up against finance and money and which are controlled by government. So this is like not unexpected. And once there is regulatory clarity in crypto, the kind of the investable opportunity set at that point will probably be diminished. Like we should all pack up and go home. Like the reason there's an opportunity here is because of the current uncertainty to some respect.
Yeah. What I mean, how do you two, maybe Ben, we can start with you, but Santi, I want to get your take on this too. Like, how do you both view the price action today? And like, because I'm looking at these prices and it almost does feel like a bit of a narrative violation. Seeing, I mean, these are kind of rough numbers. Like Bitcoin's up like 70% on the year. ETH is up 50%. Solana is up 2x. Lido's up like 150%. AVAX up 60%. Cosmos is up like 20%. So we're in the light of like, we've nuked every company. Half the reputations are dead. We like the whole industry. If you don't work in the industry, is kind of a laughing stock. But prices right now are 2 times off the lows. So I'm curious how you like view this price action.
Yeah, well, look, I think I think that tech has rallied this year overall. Like if you look at kind of the biggest 5 companies in the U.S., they're up 19% year to date. The S&P is roughly up, kind of flat year to date. So if you think about crypto as kind of being, true. Tech beta plus, it kind of makes sense. But look, like I think that this year in liquid markets, I think there's going to be a fair amount of return dispersion between different names and in more of a token pickers market. And what I'm kind of, this doesn't directly answer your question, but what I'm a little bit makes me a bit more bearish overall is, on the 1.1 trillion of crypto market cap, there's roughly like 5 to 6% just inflation per year. So $55 to $65 billion of like supply structurally coming online through token unlocks and staking rewards. And I'm just not sure who's going to buy all that. And so I don't think retail can absorb all that. I think institutions maybe come in and buy Bitcoin or Ethereum, but I don't think they're going further down the list than that. And I also think that crypto VC does not have a super strong bid right now. And so that makes me, I do think there is an element of like a relief rally that we've seen this quarter on some of those names. But I think like, again, this year will be very will be very narrative driven. And like, if you own like the top quartile, you could deliver significant alpha versus being in the bottom quartile. We'll have like a very correlated, market environment.
You still think it'll be narrative driven? So we had Kane on the podcast, and one thing Santi and him were getting into, and that episode drops on Monday for anyone who's listening. But one thing we got into is like narrative driven rallies versus and like narrative driven cycles, and when that could end, and when maybe cycles will be driven by, or like winners will be picked by things like cash flows instead of just narratives. And I kind of hear you pushing back on that a little bit.
So maybe I used the wrong term in narrative. I think there'll be dispersion in performance, and that performance will be driven by fundamentals and narrative.
Yeah.
So just as an example, like we were looking at some interesting data. So I mean, last year, if you look at in 2022, kind of the top 250 tokens on CoinMarketCap, and look at performance from like Jan 1 through December 31st, the median name was down kind of 85%, and like the median name in the top quartile was down 64%. So there was like kind of nowhere really to hide. But if you go back to like 2019, 2020, kind of there was a lot more variance in the market, and you had like DeFi break out during certain time periods where, the majors were basically flat. There was significantly more kind of dispersion. I do think fundamentals matter. I think long-term fundamentals, the market is a weighing machine, not a voting machine. But the reality is like the market is in crypto, like these DAOs are still in price discovery. They're a brand new asset class. So we could have a debate around, should MakerDAO be valued at 10 times earnings or 100 times earnings? And that probably matters more than whether earnings are 50 million or 70 million, right? That's like a 40% difference versus a 10x different on multiples. So I think multiples matter more. Multiples are dictated more by narrative than fundamentals, like perceived growth, and it really is what drives it.
I guess on this point, Ben, I'm really curious to get your thoughts generally overall on the crypto VC market. I mean, where you guys sit, you traffic in both public and private markets. You have a growth fund, you have a liquid fund, you have a credit fund. So you're doing a bunch of strategies. But overall, like, walk us through like how, for a founder or a project out there, like how much capital is actually there to invest, to absorb a lot of this supply that comes online. I'm just sort of curious, some of the trends and kind of things that you're observing in the market.
Yeah, I think this is a major challenge right now. So if you kind of look at crypto VC, we're looking back since inception, there's been roughly like $85 billion invested in crypto VC for the past like 13, 14 years. About like 60 billion of that 85 billion was invested in the past 2 years. And, like just rough math, if you assume that 60 billion bought like 10% of these companies, that's like $600 billion of kind of private company market cap that's been created in crypto over the past 2 years. And my sense is, just like if we kind of draw proxies to like public tech and liquid tokens, those names there's probably 400 billion, say 2/3 of like, unrealized mark-to-market impact on the privates that have been deployed. And we haven't really realized a lot of it. Like FTX was 32 billion, BlockFi was 5. If you kind of add up the names that have like where the pain has been experienced, it's maybe like 50 billion. But what we're seeing is, I mean, there are just a lot of companies that are kind of zombies, for lack of a better term. They may have runway, but they have no real product market fit. They're burning cash, or maybe they're making some revenue, but they have negative unit economics, like their activity is incentivized. And they're kind of fast approaching the moment of reckoning, where maybe I think the majority of these teams are going to see runway depleted by, say, Q4 of this year or early next year. So right now, look, we've looked at deals where teams have a couple months of runway left and are trying to raise a bridge round. We've looked at teams that where there's no hope of ever clearing the pref stack, or we've looked at teams that have kind of been returning capital or trying to be acqui-hired. But there does feel like we're going to see a lot of down rounds, a lot of kind of pay to play, and I think this is kind of the mess that the excess of the last few years that we're going to have to like clean up as an industry. And look, I don't want to be overly negative, because on the other hand, I think there's a great deployment opportunity right now. I think there are incredible founders that are building in really, really interesting kind of verticals. But I also think it's important to be intellectually honest just about this kind of deferred pain, deferred mark to market that is coming over the next couple of years.
I was having this conversation today with fund of funds, probably one of the largest one in crypto, and they're like, it felt like they were very impatient now. I was like, well, wait a minute, guys. Like, impatient in the sense, like, tell me. I think the specific question was like, tell me an application that has real traction and like killer use case. I was like, okay, good point. You have me cornered. And I guess the question for you is, are you experiencing, like, do you feel like there's like a lot of fatigue in this? Like, there's folks that increasingly are skeptical, critical of crypto, look at it when you talk to potential LPs and they're like, we just don't believe that the use case is there. It's just, this is just a casino and people speculate. Maybe that's the use case and we should just be more honest about it. But I'm curious if you feel that the bar is much higher for someone coming in for them to invest in the space. They'd rather just maybe go to AI or whatever.
Yeah, I mean, I think particularly like after ChatGPT, which got to I think 100 million users in 2 months, it was like a very people like tangibly could understand the impact that technology has. Whereas, with crypto, there may be 6-7 million users on Ethereum, and it's been close to 8 years. So I do think it's difficult for people to grasp like what the real use cases are. And I think that's spot on. Like, people don't really care about zero knowledge proofs or layer 2 scaling. Like, the institutions that are allocating to the space, what they're, I think, more focused on is like, why does this technology matter? And I think for use cases, like Santiago, we obviously talked about this a ton. Like, just, I think stable coins are probably the most real of any crypto use case. Clearing like $7.2 trillion on Ethereum last year. It's like 60-70% of Visa's settlement volume. It is real, and that it's gotten there in just a few years. And it's used in things like B2B payments. And I think that people can kind of grasp that. But I do think that is like the key, the next unlock, is people like really being able to point their finger at a way that crypto is actually like making a difference in their lives. And maybe honestly, like a lot of the applications on blockchain within the DeFi space are really more B2B. So people just start interacting with fintech companies and banks and don't actually, the complexity of DeFi is abstracted away. So they never really realize that their, remittance to family members in another country is, being settled via, Bitso or being settled in stable coins. But I think right now that is like the major, that is the major challenge, is nothing's really captured allocators' attention.
How big of an impact do you think Base has? And what are your general thoughts on, this is Coinbase L2 Coinbase, no pun intended.
Yeah, I mean, look, I think it's a big opportunity to bring people on chain. Like, Coinbase has 110 million registered users. And I mean, the challenge has always been that flow from like depositing fiat onto an exchange, buying crypto, but then from buying crypto, like getting it onto your MetaMask wallet or your Coinbase wallet or your Rainbow wallet. It's difficult. That step is more difficult. And so if they can kind of hold users' hands and bring them in, I think it could be, we could see double or triple the amount of users on chain, like without too much, without too many kind of underlying assumptions is my take.
Yeah. Because it feels to me like you need a hand-holding experience. Like it's almost like in the early days of a smartphone, you just had maybe email, internet was really slow. And then like Apple really pushed it forward with like the App Store. And there were certainly like, there's a lot of apps right now in crypto. There will be more and better ones. But you need like a trusted app store, i.e. Base in this case, to hold you through that flow. And it's almost like you blur the lines between what is on chain and off chain. You just think, okay, I'm entering this crypto journey and Coinbase will hold we'll walk you through it. And I think that's super important for like 99% of users.
But do you guys think that this will almost be like building a website in no code? Like when we started Blockworks, we built our website on Squarespace. And then it was like, okay, we need to graduate from Squarespace. So we went to something called Webflow, which was like a little more advanced. And then we're like, okay, now we're building like a real like media company here. We're going to graduate and from that and build like our own full stack infrastructure. Could you make a comparable thing to like, okay, we'll start by using like Arbitrum's like L3 builder or like Coinbase base, but then like once you want to actually like build this performant thing, maybe you do like the DYDX move and like try to own the whole stack. Do you think there's an analogy to be made there or no?
Not with composability, right? Because it's EVM compatible. So like it just doesn't really, if you're from a builder perspective, not really. From a user perspective, doesn't really matter, right? As long as the website loads fast and you're not getting like your credit card stolen. That's all you really care about, right? So I think, look, right now, it's like we have the smartphone, we have pretty good bandwidth. Like transaction fees are negligible now, and people were complaining about those like a year ago. Now you have a infrastructure surplus. You probably need really good apps. So we're working on that, I'd say. But I want to get your take on just generally how you think about this opportunity between like early stage, where that market is, because valuations, have they adjusted, have they come down, are they picking back up, how much activity you're seeing there versus the opportunity kind of in the liquid market, and how you think about kind of the opportunities in both sectors.
So look, I think the valuation environment's like orders of magnitude different than it was 18 months ago. Pre-seed seed rounds are down to kind of the $7 to $15 million range. And we were tracking this data internally back at the beginning of 2022, which was kind of close to the market peak. The average early stage token deal we looked at in say January of last year was 72 million fully diluted. So you've seen a material kind of compression. And look, like I think this is kind of back to where we were in 2015, 2016, just broadly. If you look at teams coming out of Y Combinator, the median seed round was maybe at 8, 9, 10 million post. If there was a killer team, second time founder, or someone building in a really hot kind of category, maybe 20, maybe 25, but that would be on the absolute highest end. So we're kind of back to where I think we're back to more rational kind of valuation environment on these pre-seed and seed deals. I think similar, like Series A's are back to 40 to 60 million. B's are maybe 100 to 250 million. Everything is really reset. I would say anything later than Series B, you're not seeing deals get done because those companies like want to avoid down rounds. So there is still activity in the very early stage market, which I think it's the best investment environment. It reminds me of 2019 and early 2020 from just a valuation standpoint. And the other thing that's super interesting right now is just the secondary opportunities that have never existed in crypto before. So the biggest bankruptcy estates, FTX, Celsius, Voyager, they all ran big venture portfolios. I think FTX has 552 line items in their portfolio of like venture investments they've made in crypto companies. So they're, that estate is divesting those names at like very material discounts to prior rounds. And then there's also kind of just secondary selling from investors who put capital into companies in 2021, 2022, more, I would say, touristy capital. So generalist venture funds, crossover funds, corporate venture funds, and now, maybe don't have conviction in crypto. So I think the fact that you can buy high quality growth names at big discounts to prior round is kind of cannibalizing any demand for, primaries. Mm-hmm. So I think it's a pretty interesting investing environment relative to what we've seen at anytime recently.
How does on the FTX specifically, I don't know if you've looked into this detail, but like people started complaining, wait a minute, SBF is paying all these fees from presumably depositor money. We're bankrolling his lawyers. Is that the case where there could be a clawback? So say that you were to buy banker, like part of the FTX Ventures portfolio, you buy the position, then 3 years down the road, the court says, no, wait a minute, that was used with misappropriated capital in the first place, so you got to give it back. Is that like a scenario that you like? Does that make sense?
Yeah. So I think so most of these asset sales that are being made from these estates require court approval to begin with. So if there's any kind of concern around like avoidable preference payment or fraudulent conveyance, like that would, I think, be considered prior to approving and any of these asset sales. And then also there's sometimes like this de minimis asset level exemption where if there's an asset that's being sold that's less than, 25 million cost or 5 million at market, then sometimes those have a more kind of expedited approval process to get sold, and they don't require as much kind of as much creditor approval. They can get approved much more quickly. So there's quite a bit. I mean, there's maybe like $5 to $10 billion of, or probably closer to $10 billion of like cost basis of crypto venture assets that are sitting in across these bankruptcy estates at the moment.
Out of curiosity, what kind of discount is there, not just for the FTX stuff, but just generally in the market? Like, is this like back to 60, 70, 80%, 90% discount? Like, I'm curious.
Santi's ears are perking up.
Yeah. I think yeah.
No, because I've seen it.
Yeah.
Yeah. Like, I mean, the short answer is
pennies
yes.
on the dollar.
Yeah. The short answer is yes. Like the discounts are that material. In some cases, I think this was announced, like SUI bought back bought back their own position in that FTX had acquired, I believe like a 5 or 10% discount. So I think first look, and like a lot of these positions will have, right of first refusals or transfer restrictions. So it's not like anyone can just show up and buy. And if you do agree to buy, the company can kind of preempt you and buy back their own stock. But generally, like, yes, those discounts are very real.
Guys, there's this other market that we haven't talked about much on just this podcast in general, on Empire, and in this episode, which is buying directly from treasuries. So Ben, we're talking about like the private market deals that are kind of these down rounds. Then there's these public markets that might be undervalued, like if you're a blue chip. Then there's this third bucket, which is like these deals that kind of look like private deals because you're getting discounts, you're getting lockups, but you're going directly and buying a token. Can one of you guys just kind of give me an insight into like what that market looks like today?
God, I think we invented that market, didn't we, Ben?
Yeah.
We
did. Yeah, no, I think we did. We called them like pipe teas. So private investment in public tokens, like a pipe in public equity land, but in crypto. But yeah, no, Santiago, go ahead and.
This is the verified TM.
What was the first deal? What was the first pipe tea?
Aave probably returned our fund.
Interesting.
Shout out to Stanley and all the team there doing great work. Listen, we it was we went to them, and look, people say, oh, you got a great deal. It's like there was a lot of work that goes into convincing a team to open up and then sell you tokens. Even back in the bear market, it was like, and so we had so many meetings with them of like saying we got to restructure the token. This was the time where like the token model was like pretty broken, whereas like distributing like fees to everyone and not just active stakers. So we did a lot of work. At least Parify as a fund, we would go to the team, do so much work, show value up front, and then just say, hey, listen, we're willing to be a long-term partner for you, and would you, I guess you could sell in the open market. What's going to be the signaling of that versus I would consider this is like a fundraising in of itself, because you're parking tokens to a good custodian that is going to commit it to, like, there was some clause in there that was like, we're going to help you in XYZ in a very concrete manner. And so we did that with so many other projects after that. And then others started copying the market. Like we were one of the largest investors in Lido. And then like there was like a few funds, I think it was Dragonfly and like Paradigm did execute it on, but it had to be on chain. Like it was like they formally wrote a proposal in the governance forum and said, hey, we want to buy X%, and the token holders would vote, and sometimes it would pass, other times it didn't. Like when FTX Ventures, funny enough, or it was Lightspeed, wanted to buy Sushi, it got denied by the community. But yeah, I think for a team, it's, you know, you always want to find a good partner, right? And this happens, like as Ben said, like pipes are fairly common. Like Warren Buffett does this exceptionally well. I think he probably is going to do more of these in this current environment. He did that in the global financial crisis, and you know, for a team, it's great insofar as you find a really good partner, right? That, by the way, locks it up for multiple years, right? When you sell in the open market,
so it is like a private deal, right? And that you're like, let's say you buy from the Lido treasury today, you might get, so Lido's trading at 2.2 fully diluted today.
Get some discount.
You might get it at like a 30% discount, but you're locked for a year or two. Basic, yeah, that's like the basic structure. Yeah.
Yeah, you factor in an illiquidity discount. If there's an options market, then you can also reference that as just generally look at the volatility of the token and say, hey, listen, if the vol of the token is like 20% or so in the last like X%, well, we should be getting probably that plus an illiquidity discount, right? Yeah. So hopefully not to give too much of the secret sauce here, but anyways, teams can try to do it. Not all of them actually can do it, because at the end of the day, you really need a hustle to prove your worth.
So Ben, what does this market look like today right now?
Yeah, I mean, I think it's, I think there's a little bit of adverse selection in the market today because token prices are down so much. So teams to then sell at like an additional discount of 30, 40, 50% is, I think, a lot for teams to kind of swallow. So the teams that are doing it are the ones that actually like need to extend their runway or have like a very firm use of proceeds for that capital. Back in 2021, early 2022, I think there were like, you know, massive deals like this that were getting done. I think today it's a bit less common.
That's interesting. I didn't realize you guys started that with Aave. That's cool.
I mean, if anyone wants to contest that, feel free to comment. But yeah, yeah, it was a big part of our strategy.
Yeah. Ben, any other hidden stories from the early Parify days that you and Santi had there?
Too many.
Yeah. The best one for me was, and it's relevant in the sense of when people ask you like, how big do you think this space is going to be? It's sort of like this idea that you underestimate like what can happen. And the timing is really difficult, but like, I think we were having discussions around how big DeFi could get, how much capital could be locked in some of these protocols. And like, we were modeling out, like Aave had like, it was like 4 or 5 million in deposits, maybe a million. Yeah. It was like less than 1 million when we were looking at it. And then all of a sudden that went to like 200 billion. It was like, or I don't know if no, actually not 200 billion. It was like in the billions, right? Like that to me was always like, yeah, you can think that you're smart. You think like we're using these things, and all of a sudden it was like, yeah, how like you just go from less than 1 million to a couple billion, and you're like, okay, well that happened.
Yeah, I mean, I think in every model that we built, we were thinking linearly or more linearly in terms of growth, and like the pace of like acceleration after DeFi summer for that like next 12 to 18 months was like a far right tail. Like, you know, the upside case, it far exceeded any kind of bull case that we, I think, could have put together. No, I think the one story that always sticks in my mind from, it kind of also reminds me a bit of today's environment, was just Black Thursday with MakerDAO. I mean, that was in my, like, whereas I think back to like a watershed moment for the space, I mean, everything could have changed. I think ETH was hugging like $80 at the time. And if it would have broken $80, MakerDAO would have basically—
There's no DeFi. You could argue there's like no DeFi. Yeah, sets DeFi back 5 years. Yeah.
That was existential.
Wait, actually, for people who don't know that story, can one of you maybe actually share that a little bit?
Yeah, Ben, go for it.
So this was in I think the second week of March in 2020, and this was kind of like right at the beginning of the pandemic when lockdowns were starting, and equity markets were really trailing off, and there was one night, I think it was a Thursday night or Wednesday night into Thursday, where everything was down like Bitcoin and ETH were down 50% in like 12 hours. And alts were down, some of them were down like 60, 70%. And it actually happened in like 2 phases. So, there was like 6-hour phase where Bitcoin like kind of went down 25, 30%. And then people like kind of bought that dip, and then it went down again and just crushed a number of funds, a number of, there was just a lot of stress in the system. But specifically on MakerDAO, what happened is the collateralized debt positions, where people had posted ETH and borrowed DAI, were getting liquidated. The issue was that the way the liquidations worked is people bid on the ETH collateral, and because gas prices were so high on the Ethereum network, people were bidding far below like the value of those assets. This was back when gas prices were like when the network got congested, gas price, because we didn't have like L2s back then. So the like no one could really bid on this collateral. There was also only maybe like 1 or 2 people bidding because there weren't as many market makers in DeFi at the time. So basically, like the collateral that was getting bid on was getting bid at a meaningful haircut that was below the amount of debt that MakerDAO had issued. And so there was impairment to the system. And there were a few other dynamics, and Sanjay, you probably remember these more, but basically DAI was also breaking. The other dynamic, which was interesting, is DAI is a stable coin, as people know. It was breaking above the peg. It was trading at like $1.20 because there was just no liquidity. Everyone wanted to buy DAI to delever. And, there was no liquidity on Coinbase. No one could find it.
Like there's no curve, or curve was just not even like
not around at the time. Yeah. So people had to, there were maker calls all day. Eventually USDC was added as collateral. So you could put 1 USDC in and borrow 1 DAI, and that alleviated the pressure on DAI.
And by the way, had that not happened, that's very contentious, by the way. And we were advocating for it because like, guys, if we don't do this, it's going to like Maker goes like, that was the watershed moment where like people rallied behind USDC because it was like, this is one of the more important things for the viability of Maker and stability of Maker. And yeah, now we're in a world where USDC is a big part of the collateral base, but there was a lot of really anti USDC folks at the time. And it came a moment of like come to Jesus moments. Like, guys, we don't do this, we don't know if we're going to be here in 24 hours.
Right.
And was there someone on the other end of this too? Like, I don't want to use the word exploiting the protocol, but like shorting the hell out of Maker, or
I'm not sure. I'm not sure. There was maybe.
There's always rumors of miners coordinating, and
I've heard some of those.
It's hard to say, but I think I remember calling Ben. This was the night before because I had to wake up super early that morning because I was giving a class at NYU, and so we were in the San Francisco. I woke up at like 4 or 5 in the morning, and this was all happening. And I thought it was like I went and grabbed coffee because I thought like my addiction to caffeine was to a point where I like was not reading prices correctly. But I remember calling Ben the night before, and it was like this is where the big catalyst there was. I think the World Health Organization came out that morning saying COVID is a global pandemic. But more so, I remember seeing a headline that was like super stupid, like Mel Gibson and some other celebrity had gotten COVID. And I called Ben and I said, hey, man, I feel like this is the moment where people say like, oh, shit, if royalty and celebrities can't like protect themselves from this stuff, then that's where like it hits home. And
it was the NBA lockdown the day before Black Thursday. I remember the NBA lockdown.
There's like a few subtle things like that. And I think that's something that I've come to appreciate just like in crypto, like these very subtle, like you can then extrapolate and say, okay, this is why, like when you think about the Wall Street bets phenomenon, Silicon Valley Bank, like I feel like we're in the state of the world where like the information propagation, like coordination, and then the coordination of that and like how actionable things, it's just these things escalate super quickly. It was a fun 72 hours, I'd say.
It's kind of amazing to think that, like MakerDAO has kind of survived as long as it has, despite all these challenges, and DeFi survived as long as it has.
Absolutely. Yeah. I mean, the thing, like people, like we obviously think that was a very scary moment because you see something go down 80%, you're like, holy shit. But like the absolute number of liquidations that have happened since Black Thursday, there's been events where like there's been far greater, sheer dollar amount of liquidations that have happened and been absorbed by DeFi in a fairly seamless, flawless manner. And so all the more impressive that, crypto sort of built all this resiliency.
Yeah, I mean, I think at the time there was maybe a $5 million shortfall that I think was absorbed by VCs, which was actually a huge amount of VC capital at the time to buy MKR at auction to cover the shortfall. But I think that it's almost like a blessing in a way, because it stressed the system. So we were able to identify these vulnerabilities and then patch them and, build up kind of this Lindy effect. So it's almost, so to some degree, it was like a blessing that the system was stress tested then, because if it wasn't stress tested then and only experienced a small loss, like it perhaps would have been bigger at one of the subsequent crashes when there was far more DAI outstanding.
Valora is the ultimate wallet for exploring the Celo ecosystem. Easily manage over 50 crypto assets and over 30 different dApps for swapping, sending, and managing your assets, all from your mobile phone. The world is mobile first, and Valora believes that crypto should be too. Their global app is localized in over 13 different languages and over 100 countries, giving crypto explorers like you a simple and accessible way to send payments, purchase digital goods, and access a suite of decentralized financial services. If you want to see real-world use cases for crypto, Valora's in-app dApps page is the easiest way to access a growing list of the latest refi and DeFi applications on the Celo blockchain. Download the app and start exploring today at valoraapp.com/empire. That's Valora, VALORA, app, APP, valoraapp.com/empire.
I think Verify really made its name as kind of DeFi and being super active in DeFi markets and it becoming a huge category. We had Kane on and we had the same, I'll ask you the same question that I did him, is like, Degen Spartan, a very well-known kind of alt personality in Twitter, always likes to post the chart of DeFi versus ETH. And, DeFi has been sort of in this kind of down market well before Terra, well before Three Arrows. Like it was just, it was coming off 6 months before kind of rates were even hiked. And so what's kind of the state of DeFi? Walk us through kind of what your thesis has been, how it has evolved, and what do you see kind of going forward? Like, as you are as excited DeFi today, or do you see opportunities elsewhere? How do you think about all that?
Yeah, I think I remain very excited about DeFi, but the areas in which I'm excited specifically have maybe shifted a bit. So I think like big picture, maybe there have been 3,000 to 4,000 DeFi projects that have kind of launched since DeFi summer. That decks we've seen in other universes we monitor, and maybe there are 30 to 40 of those that are even relevant today, and maybe only 5 to 10 that actually truly matter. And maybe a subset of those will actually kind of survive long term. So I think the vast majority of activity has been, there's been a lot of experiments, and many of them have died by, death by governance, death by lack of originality or lack of community, or some sort of smart contract bug. So I think this like first vintage of DeFi names was really interesting. I think like we learned a lot, but basically we really only have, as I think about it, product market fit in 2 areas in DeFi today. Spot trading mostly on AMMs, and then borrowing and lending on Compound and Aave. And maybe there's a little bit on insurance and perps and things like that, but there's not really much else outside of that. And where we've been more focused recently has been on this theme of kind of more permissioned DeFi and tokenization of real world assets. And it's not mutually exclusive with kind of the permissionless DeFi world that, we've all come to know and love. But it's interesting because I think it accesses like a very, very large TAM and solves some very solves problems that are really interesting and create a lot of value. So that's been a big area of focus for us. So it's, you know, it's a more regulated DeFi where institutions that have gone through KYC AML are trading, lending, borrowing, buying insurance, you know, issuing securities, but all in a permissioned, regulatory compliant, you know, environment. And so that's really where we can, you know, double click on this more, but that's been, I would say, our kind of major area of focus as of late.
Yeah, I'm curious to dive just a little bit deeper in that, and obviously, it sounds like liquidity is really dried up. Like you have a lot of the centralized players have gone out of business because of terrible risk management, and it's pretty hard. There's like a few pieces of infrastructure that have really been gone away or just severely handicapped now in the centralized manner. Do you think that that shifts on chain at some point, or are you excited and also looking at building a better Genesis with a better team and risk management in place, or a better BlockFi? I mean, I'm curious how you think this. There's been a lot of ashes currently that and voids in the market, particularly liquidity, that needs to be kind of filled in. Where do you think that infrastructure gets built, and by who?
Yeah, so I think that, and maybe this is a contrarian take. You guys tell me, but I think that there's this narrative that CeFi is dead and like not coming back, and I think kind of the BlockFis of the world, or different iterations of BlockFis with better risk management, are gonna come back, and they're gonna be important in the space. But I think they'll look different. So, you know, some sort of hybrid of CeFi and DeFi where you get the benefits of DeFi, like the transparency and the global nature and the programmability and the instant settlement, but you'll have the front end of a CeFi platform, which is, you know, more user friendly. You can pick up the phone and do, you know, you can get tax forms. It's KYC AML. There's kind of customer support, and you kind of get like the best of both worlds. So I think that is, you know, that's going to be a major theme. I mean, we have to ask ourselves, like, what's interesting right now is, you know, on MakerDAO, back to MakerDAO, or even Compound or Aave, people can borrow stables at a much lower rate than you can borrow in OTC markets, but people aren't doing it. And despite the fact that it's maybe 600-700 basis points cheaper, and so the question is why? And I can tell you why. You know, my thesis for it is just that, you know, people don't want the stress of interacting with smart contracts. The infrastructure isn't totally there to, you know, get alerts in the middle of the night if the market's trading down. You know, if the market's trading down, and you have a position with, you know, Galaxy or, you know, Cumberland, you know, they give you time to post margin. It's a bit more white glove experience. And so people are willing to pay more for that experience. And so I think there's a way to really bridge the two worlds that, you know, would benefit both, I think.
For anyone listening, I was telling this to one team that I invested in, JPEG, for NFTs as collateral. I said, guys, why can't someone build like a smart contract that has a time lock where if you get liquidated, it goes into this escrow account that has a time lock where you can refill collateral for 48 hours and you pay like an annual like insurance fee that you pay the prime broker, like, and it's a fee for the protocol. I'm like, hey, can Aave, hey, Stani, you listening? Like, why don't you just build this? Because I know for a fact a lot of funds for this reason don't use DeFi because, yeah, you're right. Like, Black Thursday happens, you get 3 calls to refill the collateral during those 24 hours, and it's appreciated, right? You don't want to lose that collateral. Right. And I think there's a way to like work this way in a programmable manner, right? And there's some logic and a flow that can work. Speaking of like like you reference like, you know, borrowing stables and whatnot. What's going through your mind when USDC depegs or depeg like a couple of weeks back? You and I were talking about that, but I'm just kind of curious, like as a first question into generally what you think about stable coins, central like CBDCs, Tether, USDC, and whatnot.
Yeah, I think my first like reaction was, like any like fiat-backed stablecoin is only as strong as the banking system that's behind it. And so when it first traded off, I mean, like when they gave disclosure around what their kind of banking exposure was, and Circle mentioned, hey, we have $3.3 billion with Silicon Valley Bank of the 40 billion of USDC outstanding. I think that allowed kind of everyone to kind of size kind of the exact 8% of the exact kind of shortfall. That would be if as if the money on SVB got a zero recovery, which I think would be a pretty aggressive assumption. I think the average in an average bank failure, uninsured depositors have recouped like 77 cents on the dollar. We were looking at some data, so so I was quite surprised to see USDC trade all the way down to 88 cents. And I think there were some weird dynamics over that weekend where, banking rails weren't live. Coinbase, you couldn't convert, you couldn't convert USD into USDC 1-to-1. So there's very limited liquidity on centralized exchanges. You also saw Tether break above the peg. I mean, it was a really fascinating environment. My thought in the aftermath of it, the question I've been asking myself, I'm curious to your guys' take on this, is like, what are people going to think about USDC after this event? Will people have a more positive view on it? Like, hey, it was able to like actually survive. Or will people not want to touch it anymore? And that's been, and I think you've seen since this event, USDC supply come down from 40 billion to 33, 34 billion, and then Tether supply grow. So maybe that says the market is
I think it depends who you are, Ben. Like, I think if you're crypto native, this is a supportive event for USDC. This makes you almost instills more confidence in USDC. You're like, this was really battle tested, and it gives me a bit of confidence that they'll kind of do what it takes to make sure that the peg maintains. There is a cohort of people who work at traditional financial institutions, who work in compliance departments, that were completely spooked by this. And we've had a couple calls with these folks at the kind of major payment processors and some of the bulge brackets who had considered touching USDC in one way or another that won't touch it with a 10-foot pole now. And that's because of their compliance departments.
How much of your business, you reference like it's still fairly kind of difficult in certain parts of where you used to in traditional finance, your prime brokerage, like your on ramps, like the way you cross margining, some of these things, like the infrastructure to like operate as a fund manager in crypto is still very nascent. And like when you come from traditional finance, you're like, wow, like we're in diapers here. We had the Morgan Stanley team on, they kind of were of the same belief. How much has your life changed in terms of how more difficult is it for you, given everything that's going on in the banking crisis? Obviously, we don't know. You talk about like the DPEG in large part being because banks, like you didn't have the Send network, which is like was a huge part of how how you'd settle trades, especially on the weekend. You have Signature and Silvergate basically gone out of the equation. What does that mean for like the stability of something like USDC? What does that mean for generally the OTC market, like liquidity in the market, like, and then maybe tying that into kind of this whole banking crisis and macro, but we'll get to that in a bit.
Yeah, I mean, there's a lot there. I mean, look, like I think I was listening to another Empire episode, and someone brought up the point that it's like actually it's very complex to operate a crypto fund. All the infrastructure required, that it like doesn't really make sense to do unless you're, at scale. And look, I think things have gotten a little bit easier, but it's you need to onboard with like 10 to 15 different counterparties, OTC desks, custodians, exchanges, on-chain infrastructure like Fireblocks and Copper, and you need to set up a number of complex like internal policies around how value is moved. And it does make me jealous of friends who start long short equity hedge funds and literally just have one account they log into and can do everything from one interface. So the short answer is it actually hasn't gotten, it's gotten a little easier, but not nearly where it needs to be. I think I guess the second part of your question is, or the other part of your question is kind of around the what's happened to the infrastructure recently. And I think that right now you have a lot less OTC borrowing and lending. That market is a shell of its former self. I mean, maybe down 90% if you look at loans outstanding. There's no real market for borrowing OTC. And then the spreads on even major tokens have widened out a lot. There's a lot less spot liquidity than there was previously. There's actually on chain is actually kind of oftentimes the best place to find liquidity, to find good execution. But this has caused a structural reset to the space. I think on the banking side, we in the aftermath of like SVB, Signature, and Silvergate, we've seen crypto companies able to open accounts elsewhere. At least what we've seen. So I think that's positive, but who knows how long term that is and where things will go next. I think on the last thing, just broadly on like the banking crisis, is it is interesting because we have seen just a resurgence in a lot of stuff happening on chain. Like all the metrics are up, right? Like I think Q1 of 2023 is going to be a lot better than Q4 of 2022, and some of the certain months of Q1 are going to be actually very, very good. As you look at everything like monthly actives, trading volumes, fees, originations across DeFi, it's actually been it's picked up a lot. So my sense is kind of the bank account of last resort for a lot of companies in crypto will be just USDC in a Gnosis safe wallet, and so I think that's been another kind of interesting dynamic.
Yeah, absolutely. And there's been obviously some folks that, I want to tie this into just a bit on the regulatory side of things that you kind of referenced. I think this act where at some point they made holding gold illegal in the US in the 30s. What probability do you ascribe to that event happening for crypto, where the US government says, hey, you can't hold crypto? Like how regulation's always been a thing in crypto. Like there's always these walls of worry that we need to climb. But I'm curious generally what you think, different scenarios for the regulatory environment. What are the things that you're mostly interested in and maybe hopeful that can happen over the next, 12, 18 months?
I think if I had to like peg a probability of like confiscation of property, like of digital assets, like maybe this is naive or optimistic, but I would say like low single digit percentage. I mean, I think it's non-zero, but I don't know that it's certainly not like the base case. There's also a question of if that happens, what happens to market prices? And I don't think it's necessarily the answer is that there's a massive shock to the downside. I think like gold actually performed fairly well in the couple decades following the confiscations, as it was traded kind of globally. But look, I think regulation is just the biggest challenge. Like it's been both the biggest challenge and the biggest opportunity in the space right now. And that's why, and that's why I think it just has to be a focus of everyone in the industry. And I think as the technology gets better and as we prove like real use cases that actually provide people with value, I think the regulation will actually kind of follow and catch up to that. I mean, you're seeing this a bit with ChatGPT in the AI space right now, where some people are saying, hey, we need to slow down. Like we're not aware of all the risks that this could, inflict on humanity. And other people are like, well, look, other people that are pushing it forward are saying, hey, look, like we need to come, we don't want to slow this down because this technology is incredibly useful. It's not abstract anymore. It's useful. And we should, we should figure out some guardrails, but we should push it forward. And so I think in crypto right now, like people just want to regulate it because it's like it's providing for most people very little value, and so that to me is going to be critical.
Yeah, I don't think anyone at this point disagrees that there some regulation is good. We just got to figure out a sensible regulation that kind of meets this new technology. Can't regulate new technology with necessarily old playbooks. It needs to be somewhat adapted. We've covered a lot in this episode. One of the things that I think we always appreciate is just getting your thoughts on generally what are the things that you're mostly focused on in terms of like, what are you paying attention to? What are you reading? Kind of what's interesting to you in the market? Anything else you think is interesting?
So one of the areas I mentioned it earlier that is if you look at tokenization of real world assets, it's had a bit of a renaissance recently. So we kind of track an index of non-stablecoin RWAs because stablecoins are the biggest RWA. They're tokenized dollars.
Yeah.
But non-stablecoin RWAs are up like 5x in the past 6-7 months in terms of on-chain volumes. And some of that's in treasuries.
And like, what are these things? Yeah, I was gonna say.
Yeah, it's like things like treasuries, tokenized credit. They're tokenized carbon credit markets. A lot of the categories that are getting tackled first are more kind of some longer tail markets. But there's some in the physical commodity space, projects there that have traction. But they're we're seeing there's been actual progress recently, which is encouraging because, I mean, this is obviously something people have talked about since 2017, like let's tokenize real estate and then, trade it on chain. And it hasn't worked. And so part of the question was like, well, why didn't it work? People have been trying these experiments for a long time. And I think it was lack of infrastructure, right? Fireblocks and Anchorage were founded in 2018. Coinbase custody was founded in 20. Like these products didn't exist until recently. I think there was a scalability issue. I think there was like perceived smart contract risk premium. There were all these issues, and a lot of those things have been kind of solved at this point. And so I'm paying very close attention to those markets because I think that if we have tokenized real world assets that are trading on permissioned smart contracts, that is like a very, very real use case that regulators are going to, I think, take a lot less issue with because it's basically using blockchain as rails to facilitate normal capital markets activity. So you kind of have seen this, KKR tokenized an LP stake in one of their private equity funds on Avalanche. You have some big institutions doing something similar on a permissioned lending protocol called Credix. And I think a lot of these things are kind of gradually then suddenly in terms of their adoption profile. And so that is, to me, is a big area of liftoff that we're probably one of the biggest areas that we're focused on.
Yeah. I want to kind of close this great episode on just historical perspectives because you've been around for space. I want to do a quick fire round questions, but before there, maybe the more important question, what has been like the biggest learnings for you over the last, 12 months of crazy timeline that, Jason and I used to joke because every time we'd say it couldn't get worse, it just got worse. And I'm curious, like you've been through many cycles, not just in crypto. And yeah, what is the things that you look back on and say, yeah, I think this is like the biggest like takeaways or lessons or, things that you've learned over the last 12 months?
Yeah, I think there's, how long do we have?
This is an hour therapy session transitioning to more wellness episode, guys. So yeah, buckle up.
It's fun. We did this like very long kind of internal reflection on all the mistakes we've made over the past years, and kind of tried to like group them into themes or buckets. I'll kind of rattle off just a couple. I think one is you want to partner with really good people, good founders, and there's no idea can be is too great if the person leading it is not like ethical or is not really fundamentally aligned with what they're building. I think there's a lot of like mercenary. There were a lot of mercenary founders that raised capital in this prior cycle that launched a token, launched a network, didn't really care about the blockchain space, and kind of have dumped their tokens or kind of quiet quit. And we want to generally, the lesson has been like partner with missionaries, not mercenaries, and people that are aligned with like really building valuable products in the space and thinking long term. Yeah, that's a huge thing. I think the other is incentive alignment. A lot of teams had very short vesting schedules. The token price went up. They maybe didn't need a token. They launched it too early. They got distracted by like their kind of paper wealth. They maybe monetize some of that. Maybe they're not incentivized to continue to work on building. And that's why there is something like, if you think about capitalism and like a lot of the biggest companies, that a lot of the value that's been created in the world today, it's early stage venture capitalists partnering with founders, and both groups are kind of illiquid, locked in for 10, 15 years. And then there's an IPO. And then that, the founders can maybe take a little bit of chips off the table in an IPO, but there's also regulation around how much they can sell. So there's just this like very long-term incentive alignment, and there's too much short-termism in crypto. And so, again, like these are things that, maybe we learn the hard way. The third one I would mention, I mean, there are probably like 15, 20 things I could mention, but the third one I would say is certainly like great ideas without killer execution are just completely worthless. And there were, there was some amazing technology that just never got monetized or was never really, I think, explored to its full potential in this past cycle. So maybe second, third movers in this next cycle will be able to pick up where those other teams left off. I don't know. Those are three. I know we have a shelf life on this podcast, but there are a lot of others. Those are my probably three top of mind ones.
Those are really good ones. Like I would definitely agree. The last point you make is a really good one, which is sometimes I think my best investments have been second or third iterations of a particular idea. And I think we're in that environment where a lot of people, it's like will be non-consensus to invest in another exchange or another, trading desk like Genesis. Like these businesses were like cash generative, like super profitable, viable businesses with real traction. But people confuse and conflate two things. It's like don't confuse terrible management with. It's not like banks are not a viable business model because Silicon Valley went out of business. It was just like there was a specific human error there on the execution side. And I generally think there's going to be really good opportunities. And the same is true. Like I don't think people properly are equipped on this non-linearity concept of understanding how quickly the infrastructure is developing in crypto. It took forever for Ethereum to like transition to proof of stake, but the progress that has happened since then, Beacon Chain, the merge, and then, account abstraction, like all of those changes have vast and deep implications for how apps are developed, the user experience that I think people, if you're not really close to the metal, it's hard to appreciate. But I think a lot of we're in that state of the market where even investors and, people generally are very skeptical of this technology yet again. But don't have a finer appreciation for how a good idea can work because the infrastructure has changed. And I think that's very much true in an L2 context with account abstraction. Like these things plug together. Like Ethereum is working very well. And I think just people don't give it enough credit because, in 6 months, it has changed in a very meaningful, concrete manner. And so, but you're always going to have the skeptics of like, this is bullshit technology. Like, just honestly go invest in AI and like, call it a day and, nonetheless, yeah.
No, I think that's right. I mean, I think that's spot on. Like people don't always diagnose like the why, like why did an idea fail? Sometimes due to timing, it was too early. The infrastructure wasn't there. and sometimes it's lack of execution. But oftentimes the
Mhm.
idea itself is like has a lot of merit. So I think that's
Yeah.
but I think that's spot on.
You read my mind because I want to go in a quick fire round. And the first question is, do you think that an algorithmic stablecoin will come to market and be successful?
Over a long enough time scale, yes.
Interesting. How many hours? Okay, you want to say some more?
I want to ask a clarification question. So, like when we say algorithmic stable, I think also how do we define algorithmic stablecoins? Would something like DAI or LUSD or Frax, I guess, be considered algorithmic or kind of over collateralized?
Is that like good question. I guess Frax is like, I would say hybrid, like collateral, like it's still collateralized, but it's like less collateral over time, I guess. Seniorage model. Yeah, but like some like, I guess more concretely, like a Terra, like fully algorithmic, like game theory.
I think that's tough. Yeah, I think
some collateral is what you're saying.
But some collateral or certainly over collateralized stable coins, I think are, that are not backed by dollars in a bank account. I see those working. I mean, DAI is the great case study.
Good point. Second point, do you think the U.S. loses its reserve status in a week where you've seen trades and commodity markets being now settled in different other types of currencies, China trading with Saudi Arabia and whatnot? Like, and if it happens, in what time scale?
I do think that look, I think it will eventually happen. On what time scale, it's tough to say. But I mean, if you look at our the budget deficits our country is running, if you look at our national debt and debt to GDP, which is kind of 110, 120% and growing every year. If you look at like our Social Security and Medicare liabilities and like the demographic trends in the US, like it is mathematically very difficult to grow or tax your way out of this hole. And so then I'm left wondering like, well, if there is a shift to another global reserve currency, like what does that look like? How quickly does it happen? The US is still kind of probably better than the euro, the yen, the renminbi. So what, like, could it be gold? Could it be Bitcoin? I don't, I think those are probably I think those are the best. I think Bitcoin's probably the best option, but what that looks like is not clear. I would say, yeah, in the next 20 years, I could see it, could see it happening.
Yeah. You have a blank slate, $100. How much do you allocate to Bitcoin and ETH and what ratio? And you need to hold for like, okay.
If you have to hold holding for constant for 10 years, I think it has to be something that looks close to an equal weighting between Bitcoin and ETH. I think they're very different and they can both be successful independent of one another. But whether it's 40-60 or 60-40, I think in my mind, they're equal weighting and they're both, I think, incredibly attractive right now relative to the underlying kind of fundamentals behind both of them. I mean, especially if I can stake my ETH over the next 10 years, because staked ETH is trading at a 20 times earnings ratio, roughly, as I'm looking at it. So look, I probably 50-50. I think it's tough to say one's definitively, better or worse than the other in today's market.
Yep. What do you think we see first? Crypto is sitting at 1.2 trillion market cap with this 5-6% inflation. What do you think we see first? 500 billion or 10 trillion?
10 trillion.
Nice. And what's the ratio of the market cap, the Bitcoin dominance in that scenario?
I think it's probably in the 30 to 40% range. I also think a big chunk of the market, if we get to that point, will just be tokenized real world assets.
Including perhaps a centralized, like a CBDC?
Maybe a CBDC. I think, or just expansion of existing fiat-backed stablecoins or decentralized stablecoins.
Nice. Last two questions, Jason, if you want to ask more, jump in, please. How many hours of sleep do you get? And that's less or more than in the last 12 months?
I've been trying to improved my sleep hygiene a lot. So it's been a major 2023 focus. I aim for 8 hours a night, but I still have a bad habit of like checking crypto prices right when I wake up, right before I go to bed.
Yeah.
So
You know what I started to do? I, as you know, I'm a terrible sleeper. I started to put my phone in a different room. Thank you, Jason. I think I got this from you. It's
I've been doing that for
simple,
years.
like, honestly, the best small thing like that, like when I do this, like I've A/B tested, well, not A/B tested, but like, I don't live in a simulation parallel universe. But nights that I put my phone in another room, I'll just sleep better. This is not advice. Legal.
What
financial,
about
or sleep
your
advice.
alarm? Do you have like a manual?
I don't snooze. I also suck with snoozing. I'll just like hit my phone. So when it's in the other room, it forces me to get out of bed and go.
Right.
And go. Then I just turn my alarm off, get in the shower, and get started with the day.
Yeah. This is a hack. This is the hack.
Okay.
And then perhaps last question for me is, what would you tell a younger Ben that is getting started in crypto?
I would say that as you think about investing in the space, be very cognizant of what you know and what you don't know, and don't convince yourself you know something that you don't actually know. So in other words, I think being aware of blind spots in the space is important. So even when you have very high conviction on an opportunity, I think it kind of position sizing is important, because it shows humility that, hey, you could be wrong on this. So specifically, I think there are some things I've been very confident in, these investment theses over the years that maybe turned out okay, but not nearly where I thought they would be. And so I think it kind of comes down to like sizing positions in a more humble manner, where you have more diversity, because you're going to get a lot of things wrong in the space. That's one of many pieces of advice I would have for myself.
We used to always say internally at Parify that thesis is half the battle. Position sizing is equally important. People don't spend nearly enough time thinking about position sizing, and calibrating that over time. I'll cheat. I said the last one, but I'll follow up because this is a great answer. Is what is something that you've changed your mind recently, you or as a team, as a firm, but maybe specifically just you? Because, by the way, to listeners, none of the stuff that Ben says actually represents the views of Parify. And I will say this because when I was there, I used to have to say this all the time. So I'll just spare Ben of saying this. But nonetheless, go for it.
Yeah. So I think one of the things that's like changed kind of gradually over the past year, this is maybe like not a totally popular viewpoint, but I think a lot of the just permissionless DeFi infrastructure, or like a lot of the best projects and protocols that have really had amazing runs over the past few years, like may struggle just to scale and fit into a world that are regulated. And so I love the idea. Like, I think that space will be around for a long time and will probably net grow. But as I think about like what's best for the industry and like how important regulation is, like I'd love to see, and you're kind of seeing it with some of these teams, like building out ways for institutions to actually use their products is important. I guess to be concrete, like what's changed is maybe my estimate of the TAM of the permissionless DeFi market. I still think it's a lot bigger than it is today, but I think we need to go after the permission side as well.
Yeah, definitely. Well, it's been awesome, man. Always a pleasure having you on. And I don't know if there's anything else you want to cover, but this is all I had. So it's been a great discussion on all things that we wanted to cover.
No, thanks so much for having me on. It's always humbling to be here. So really appreciate it. This is
even all the better when you don't share stories that embarrass me. Last time you shared one of my Harry Potter Lego collection. So this time we've been spared on any more embarrassing stories.
Ben has been coming to Blockworks events for Ben. I think you're one of the first ones.
One of the first DAS events in like 2018, 2019, when it was like 40, or when it was like 100 people. Now it's whatever, 1,000. So
this is a rhetorical question, because this is where Jason plugs, get your tickets for permissionless, buy now.
Ben's speaking.
Prices go up in 3 days.
Ben, are you speaking this year?
What was that?
Are you speaking this year?
Yeah, I think I am. I think
All
I
right,
am.
good. Good. So we got two speakers.
I-
Yeah, buy
am
your
I
ticket to permission
speaking?
list.
By the way, Jason tried me to ask me to buy tickets. I'm like, since when do speakers get to buy tickets for conferences? Jesus Christ, we're definitely
you know
in a
who buy,
bear
you know
market
who you
now.
know what speakers have to buy tickets for conferences is speakers who say they're going to speak one year and then bail last minute. So
Rugged
yeah.
by airlines, but fair enough. I'll
Ben,
take the blame.
Ben, this is awesome, man. You're always welcome to come on the show, and it's been a
Thanks.
great chat and fun to see you and Santi banter as well. And yeah, man, this is great.
Awesome.
Yeah.
Thanks a lot.
Thanks, Ben. Thanks
Yeah,
for coming
cheers,
on, man.
guys.
Yeah,
I
really
would tell people to go follow Ben on Twitter, but Ben doesn't have a formal. He's probably the only person in crypto that doesn't have a Twitter account that we know of. Maybe one day he'll tell us what his alt account is. Maybe Dejan Spartan. Who knows? Maybe
Spartan. Cheers,
Yeah,
guys.
so you can email me or send me snail mail.